the webinar. And this way, participants will get a copy of the recording that you can listen to on your own time. Or for those people who registered and for whatever reason were not able to attend, they can still get this valuable information. I'm going to share a little bit about Compass for those of you that are not familiar. Maybe you're joining us on our monthly webinars for the first time. So Compass has been around for 13 years. We are an award-winning human resource firm dedicated to providing HR expertise to small and mid-sized businesses. Our work is really focused around 4 key areas of human resources that make a difference in business profitability, scalability, and business valuation. And those areas are compliance, operational controls, dealing with workplace conflicts, and employee and team behavioral assessment utilizing the predictive index. We are headquartered in Hauppauge, Long Island, and we service a tremendous amount of clients in the tri-state area, but our work is also national in scope as we handle HR needs wherever our clients have operations. And with that, I will let Ron share with you a little bit more about Creative Plan Designs, his firm.
You were doing so well. Well, we've been around for a long time. 1979, I bought the company, and we have just gotten bigger in the time. We do one thing, and we do it really well, and that's administer retirement plans. We don't sell product. We don't do estate planning. We don't sell insurance. We just do retirement plan administration. We're one of only 62 CFEC certified firms in the world. Doesn't mean much to people outside of our industry, but understand that most people are not credentialed and not certified in our space. It's a very strange phenomenon. And we actually have human beings that answer the phone, which means I need to have human resources because I have humans running around the place. Our job primarily is to deal with the stupid in the rules and to keep you in compliance. And it's becoming a bigger problem these days because the governments are all very, very hungry, and they're looking for ways to take your money to fund their retirement plans. So we basically stay in our lane, and this is what we do.
And I think one of the things that you do, though, that's really so tremendous and very, very different from other players, especially the big box firms, is you actually design a plan that allows the company to reward key employees and provide different levels of benefits based on job category or function or other types of objective criteria. And I just find that most business owners or C-suite executives running firms are absolutely unaware that these options are available to them. So
well, that's true. Yeah, when you're in that big box space and you've got a single individual trying to cater to 400 or 500 clients, everything has to be a cookie cutter. They may be excellent chocolate chip cookies with 3.17 chocolate chips per cookie, but if I am gluten intolerant or allergic to chocolate, I'm in trouble.
Absolutely. So we're going to dive right in, and I think this morning's format is really just going to be interactive. So as we promoted this webinar, we sent kind of some of the key data points that we were going to cover. And so in our conversation this morning with Ron and myself, we want to make sure that you get your questions answered. So again, if you want to send us questions in the chat box, you can, but Ron and I are just going to be having a conversation. I'm going to be asking him questions about what is going on with state mandated retirement plans. And I guess, Ron, let's just start with the basics. What is a state mandated retirement plan?
Well, the states have taken, actually from a societal perspective, the federal government started talking about this about 10, 12 years ago. And the states were paying attention to it. And the problem is more than half of all the employees in the country don't have access to a retirement plan. Because small employers generally just don't put them in because they don't. They're too busy running their business and they don't think about it. So the states have said, let's figure out a way to help society accumulate some money for retirement, because not to be, to exaggerate the problem, but it is a crisis. One of the statistics, and the statistics are all over the place, but the average person in the state of Vermont has less than $14,000 at retirement age. So you can retire comfortably as long as you die by next Thursday. These are the problems. So how do we help people accumulate money in a managed process? And that's where the state started to try to come in to try to help this. So the first state to do this was California. And California said, you will have a retirement plan. If you don't have one of your own, the state will have one for you. And that's where it starts to get hinky, because each state has its own set of rules and thought processes how to approach this from a social and economic perspective. And one of our internal bumper stickers in our office is that people that write rules.
Oh my God, this guy's got to shut up.
Was that me?
No, I don't think so. I think it's,
Okay.
it's one of our webinar participants.
Okay. Yeah, because if I have to shut up, then we're just done.
I think so.
And now I lost my train of thought as to where I was with this. So anyway,
Well, how many states have this legislation on the books or already enacted this
14.
particular mandate?
14 right now, but 46 in total are looking at it and trying to figure it out. And so that's where we are with that. So, where you are is an issue. So, so for example, in the state of Washington, the city of Seattle has its own plan separate from the state. In New York City has a plan separate from New York, from New York State. Now, each one of these little fiefdoms is creating its own set of administration requirements and its own set of committees and trying to figure out how to do this. And where I was going is that the people who write rules don't administer benefits programs of any sort. They don't practice tax. They really don't understand the math. But I think most importantly, they've never made a payroll. So they don't understand the day-to-day problems of running a business. And the smaller the business is, the more problematic it is, because small businesses generally don't have. Who's in the background being rude?
Yeah, I think that person's going to need to go. My apologies, Ron. Did I lose you too, Ron? Oops.
Ron is muted there. Christine, if you want to unmute him and then
Yeah,
mute everybody else.
I see what I've done here. You would think I would get better at this with time, but here he is. Okay, Ron, are you able to unmute yourself?
There we are.
Thank you.
I'm
My
back.
apologies.
So I was saying small businesses don't have a lot of things like IT. They generally don't have HR. They don't have, they may not even have a separate bookkeeper. So the business owner comes home at the end of the day, sits there, cranks open QuickBooks and TurboTax, and tries to take care of payroll functions at a time of the day when they can't get somebody on the phone. So when you have to start doing processing that for a state or any kind of regulatory agency, it becomes problematic because it's not what they do for a living.
Right.
So when the state comes along and says this should only take you an hour a week, it's like, one, it's my time for an hour a week. You're telling me my time has no value, because they're all saying this doesn't cost the employer anything. Well, just the wine expense alone to be able to drink enough to get through your process has got a cost.
Right. Well, there's some pretty steep penalties that some of the states are assessing if employers are not in compliance or not offering these plans.
Well, this is actually a budget item in some of these states. They're looking at revenue that they're going to generate from these plans. So one of our problems that we have currently is who owns the employee? And we're seeing this in your space more than mine. But for example, with the employees now being more mobile, especially since COVID, and they're in multiple states, who does the employee belong to for things like state payroll taxes?
Right.
So we're already in into a contest between the Northeast corridor, because Massachusetts thinks they own the payroll taxes for the employees that work in Massachusetts companies, but live in New Hampshire. Connecticut thinks that employees that live in New York belong in a Connecticut state plan because Connecticut's making money on the state plan.
More likely to wear something.
So where do the employees go?
That's approved by their group. So we want these employees to wear these shirts for the next year, right? Once a week for the next year.
Why am I echoing here?
No, you're not. There's
Something big, become a mentor.
someone who's not on mute other than you and I.
Some of the other outreach efforts we have, I talked about it last month. Suffolk County, I'm sorry, I didn't give credit where credit is.
Sorry, Ron, I think I fixed it. So are there benefits of participating in a state mandated retirement plan to the employer?
There can be. I mean, a lot of times the employer would like to have benefits for the employees, but really don't want to go through the expense and process of putting in their own 401k plan or retirement plan of their own. They may not have access to it. In many cases, it's just too small. You know, we talk about all these tiny little plans that are out there, and that's one of the problems. Setting up a retirement plan is the same cost and same effort, whether you have 3 people or 75 people. You know, the documentation and the compliance and the consulting up front is all pretty much the same. So when you start looking at these little plans and they're fiscally driven, the people who are giving advice to the plans they still have to make a living as well. And it starts with the financial advisor. And if you got a little plan that's got $30,000 a year going into it, the financial advisor has no way to make money with this. There's just not enough volume, but it still takes the same amount of time. Similarly, people in my position who were doing the administration and the design on the plan, it's the same amount of time, whether it's a tiny little plan or a big one. In fact, oftentimes the little plans take more time because those decisions are more crucial to the people involved because it's a bigger percentage of what they have. So they get more emotionally engaged in it. So I think once this all works out, it's going to be a valuable component, and it's going to give people access. And it's very easy for people that are business owners to sit back and say, what's the big deal? The employee could just put money into an IRA in April and write a check for $3,000. But most employees are living paycheck to paycheck. And they can afford $50 a pay period, but they can't necessarily just write that $3,000 check in April. And that's the component of society that's being addressed by these things. You know, it's easy and people don't see it. The downside is almost all of these state plans are Roth 401k components, so there's no tax advantage to the employee currently. And that becomes interesting because that $3,000 contribution that the employee might be making to a 401k plan, maybe they're getting $500 of tax credit from doing that.
Right.
But in this Roth environment, they're not getting any tax credit. So it accelerates the amount of that are exacerbates their lack of take-home pay. Again, it's not horrible. In the aggregate, it's going to be pretty good, but right now it's clunky.
Well, and I also understand that in a lot of the state mandated plans, the employer is not allowed to make contributions or matching contributions, and those contributions often incentivize employees to participate, kind of nudge them over the edge. Is
Well,
that
you know,
the case?
yeah, and that's an interesting component also, because every one of these states, when you read through their internal propaganda on it, is talking about, in today's world of trying to grab employees and hold on to them, this is an incentive to the employees, but you're taking away the best methodology that the employer has to incentivize the employees. They don't know how to deal with it. They really don't know how to deal with it. But the other thing, and this was just a cynical thought that I just had while we're talking about this, if they do this with a regular deductible format, the states will lose revenue. So by having it in as a Roth, the states are still going to keep the revenue from an income tax perspective, which is part of their budgetary component. You know, in the state of Washington, it's already got a few $100 million sitting in this plan. This is significant.
So in a state mandated plan, do the employees have access to a financial advisor or how to make choices and where to invest their money within the plan, or does the state automatically make those choices for them?
Well, it depends on the state. A couple of states do have outside financial advisory firms that are attached to it. Generally speaking, the states will just pick an array of funds that are available, and you're sort of stuck there in those funds. They're almost all target date funds, which are tied to your age versus retirement date. It's sort of scattered.
Mhm. So I'm imagining, because you and I are in New York and we have a significant New York following, many of the people on the webinar may be in New York. Now, New York has these laws on the books as well as New York City, but there's no place to actually put funds or enroll employees as of yet. Is that correct?
That is correct.
So what are the New York regulations that have been set, or what is the guidance, and do we know when these plans will be in place?
Well, definitionally, they're in place now. They just don't have any, they put the cart before the horse. They're going to get back to us and tell us what we have to do and how we have to do it, but they haven't figured that out yet. New York City has appointed 5 people. They say they allocated $450,000 to run the program in the city, which again, back to a cynical comment, this is never going away because bureaucracy never gets smaller. So you know that these people are going to be around with jobs and benefits looking at this forever. And if the state comes up with their plan, New York City will merge into New York State, and they don't have a plan for that transition.
Now, is New York and New York City an IRA-based plan, a Roth IRA?
They are.
Okay. So for those of us that have retirement plans in place, like a 401k, is there anything that we need to be worried about or mindful of?
Well, it depends on, again, the state. So for example, all the states on the West Coast, it's your job as an employer to notify the state that you have a plan, which means in the Cal Savers plan, for example, which is the most robust with the clearest set of regulations. In the Cal Savers place, you actually have to go in and register for Cal Savers and then make yourself exempt from Cal Savers because you have a plan. You would think that the states could just go to the Labor Department and see, oh, your Creative Plan Designs has a plan. I don't need to do that.
Right. And when you're registering with the state like that, how much information do you need to give them about the existing plan?
Well, I went through the Cal Savers thing. It took me about an hour and 40 minutes and I sort of knew what I was doing. But again, the information is not difficult, but the websites are not clear and easy to maneuver.
Right.
And what's not clear to me is, one of the cases that we've already seen is New York is getting into a contest with Connecticut. Because one of our clients happens to be in Connecticut. They went into the Connecticut plan and now they're sitting there and Connecticut saying, well, the employees in New York haven't been registered. And New York saying there are employees, go away, you can't cover them. We want them. How do you register this?
Right. And I would imagine if you're paying withholding to New York State, why would you register an employee in Connecticut?
Well, that becomes part of the issue.
Right.
So, there's going to be opportunity for penalties here. And ultimately, you may not end up paying penalties, but the expense and time trying to get through this, this morass of inconsistent rules could be painful for the small employer.
Oh, I'm certain it will be. I mean, we've just seen the complication of, companies with 20 to 25 employees and one employee is relocating to North Carolina. And you have different benefits, different disability. Some have paid family leave, some don't. Making sure that the tax status of that employee, right? Because New York State, if they're performing any work in New York State or for a New York State employer, New York wants those taxes, but it's very clear on the benefit side that employee, if they're not physically working in New York State, is not eligible for paid family leave or disability benefits. So you also have this interplay of two different issues, mandated benefits and taxes, that don't agree and don't seem to speak to each other.
Well, they
So
don't.
Right. What if someone has a simple IRA or a SEP? Does that qualify as having a retirement plan in place?
For the states that have acknowledged that, the answer is yes. So a couple of the states have said, if you have an employer-sponsored plan, and then other states have actually gone and listed the types of plans that would qualify. And simples and SEPs seem to be okay. They simply want the employees to have the opportunity to do something at work. Other places it gets weird is who is an employee for purposes of this. Some states are 18, some are 21, some are 19. Some define it still as 180 days of service, some are 120 days of service. California is 5 employees in the calendar quarter. And an employee is defined as anybody over 18 who got any compensation in that calendar quarter. So your number can go from 5 to 1. So if I'm self-employed with 4 part-time kids in the summer, I now have to put myself in this plan.
Right.
So they're not consistent as to who is an employee for reporting purposes in this space.
So they're not excluding owners.
They're not excluding, most states are not excluding the owners. And other
Interesting.
states are saying that even though you are an owner-only plan, like New Hampshire is very big, New Hampshire or Vermont, they have a much larger percentage of self-employed people than any other state. And they're not making you come in, but they are saying that you're allowed to come in if you choose to.
Okay.
It's just some of the terminology. For example, Vermont and Washington, they're saying that the employer mandate is voluntary. That's the kind of double speak language we're getting into.
I was going to say very confusing. Well, and I'm also thinking about, independent contractors and 1099s. Like the Department of Labor and the IRS do not agree on their definitions. So if you have 1099s working for you, that probably also raises an issue of who should be participating in these plans.
Well, it always comes down to who's the employer. And one of the things that we've noticed in our side for the last 3 or 4 years at least is New York City is doing data mining far better than any other government agency in the country, looking for those people that are misclassified from an employee perspective. You know, they have all these little kids running around who would normally be wearing a paper hat if they didn't have this job with the city. And they're doing really spectacularly good data mining of linking up 1099s to employers. And if you're getting a single 1099 and a particular employer has nothing but 1099 employees all getting a single 1099, they're probably employees.
Right. Now, are any of the state mandated plans subject to ERISA?
Only Massachusetts, which is also odd because Massachusetts plan is also only for not-for-profits.
Interesting. Now, in New York, it's all employers, right? With 10 or more employees.
Except New York City, which is 5 or more.
Okay. So it's always great when New York and New York City agree to disagree, because if you have people in the city, but you also have people in other parts of New York, as we've talked about before, it just gets extremely complicated. So what, generally with these type of programs, there's employer requirements to provide notices, to provide communication. What type of communication pieces or what obligations do employers have to communicate these options?
Again, it depends on the state, but they're all similar to anything that you would have to do in HR for health insurance or a traditional 401k plan. You have to let the employee know that they're eligible to be in this plan. This is a more aggressive set of reporting because these plans are generally automatic enrollment. So you have to tell the employee, we will be taking money out of your pay. Here's the website that you have to go to if you don't want us to do that. The states will then start sending notices to the employee as soon as we tell the state that the employee is with us. So we're getting notices, the employee is getting notices. And again, depending on the states, because I went to all of their websites, some of them are friendlier than others.
Mm-hmm.
And it's, it's one of those things where the employee is saying, what are you taking money out of my pay for? And if you don't give them the notices, I'm trying to remember which state it was. Hold on, let me scroll down here. They actually said it's criminal charges for the employer to not do certain things. Connecticut.
Wow.
So
I mean,
Connecticut is
right-
age 19 and 120 days of service. So you have 365 entry dates going on in this plan because it's on your 121st day that you come into the plan if you're 19 years old. And if you don't give certain notices, and you have to document the notices and hold those notices for 3 years, and they must be in paper form. In fact, only one state is allowing electronic notification. So you have to hold paper for 3 years. And Connecticut is talking about civil as well as criminal penalties for failure to give these notices. Now, is anything going to come of this? Probably not, but you don't know.
Well, I think it's like anything else. If you have an audit for a particular issue, they're just going to ask for more things. So while we're here, let's see your notices about the state mandated retirement plan.
Sure.
So someone had sent us a question. Do the common ownership rules apply?
They do.
So,
which creates another mess. So one of our clients has a security company. They have all the people with the little cars with the yellow lights on top. And they have 1,100 employees in 5 states, and 4 of the states have state plans. And it's one big company for control group purposes, and it's one big company to each one of these states for the state plans, which states are we going to annoy here?
Right.
Or do we pay attention to Louisiana that doesn't have any rules, and we say that the Louisiana employees, and we're not going to cover them?
Right. Well, I would think in that situation, it would really benefit the employer to maybe have their own plan.
Correct. And the real advantage to having a 401k or a simple or a SEP is that we know what those rules are. They're codified, they've been around for a while. We just know what the rules are. And in this space, with the state plans, we have no rules yet.
Well, I think the other advantage to an employer-sponsored plan, at least from the HR standpoint, is it's a lot of employees, when they're looking for a new career opportunity, are asking about the ability to save for retirement and the provisions of a retirement plan, particularly if there's a matching element or a safe harbor element. So attracting and retaining, quality employees is really critical. Like we just did a webinar at the beginning of the month on the Great Resignation. And having a benefit like a retirement plan where the employer is giving money and there's vesting really helps to attract and retain employees, especially for small employers. I mean, you gave a statistic at the beginning. I think only 4 out of 10 employers under 100 employees offer a retirement plan. So having a retirement plan can be a positive. This really could be a compelling opportunity for smaller businesses to say, okay, it really does make sense for me to have my own plan. I'm going to have more control. I can make an employee contribution. So I'll tell you a little crazy story. We have a client in Brooklyn, and they have a lot of employees that work in a warehouse. And they gave out very nice bonuses this year. And those bonuses were subject to workers' compensation. And they got a surprise $50,000 workers' comp. So in conversation with the president, we decided that next year, that type of incentive is going to go through their 401k retirement plan, because now that is tax advantage from the employer's side. That money is not subject to workers' compensation, and it gives him a great way to incentivize employees to continue to stay on with him. So I think there's a lot of benefits to having an employer-sponsored plan and setting up a plan in a way, in a manner that is going to allow that business to incentivize its key employees and attract and retain key employees versus just relying on a state mandated plan.
Well, you have just more flexibility with your own plan. So to your point, I can cover who I want to cover and reward people differently. The same way that compensation, regular salary, is discriminatory. I mean, all of our employees don't get paid the same. So why should the pension benefit be all the same? That's just another form of compensation.
Mm-hmm. So Ron, what type of employer-sponsored plans are available, and how could you be helpful in that process for companies that want to have an exploratory conversation?
Well, it's just a function of what you really want to do. So for a single employer, like a self-employed individual, there are 104 permutations of retirement plans for that individual. And as we start to get those pesky employees into the mix, well, I just said that to HR, didn't I? The choices and options become bigger. We just have more of a toolbox to play with. So we start with, one of our internal cynical statements again is, I don't care about the employees unless the employer cares about the employees. Tell me what you're trying to do, and I'll tell you how close we can get there within the law. Who do you like? So retirement plans are 4 things. It's a tax shelter for me. It's a retirement plan for me. It's an employee benefit. It's an employee benefit for select employees. And those are not mutually exclusive. So tell me what you're trying to do and what your budget is, and it will work backwards. And sometimes the state plan may be the best place for you to be. Sometimes a simpler SEP may be the best place to be. We're not additive to that space. We have nothing to do with it, but it's still in your best interest. That's where you should go.
Mhm.
Just an FYI, this year is the first time in 20 years that all simples and SEPs need to be restated. So whoever has got your money, the custodian of that plan, should have brand new shiny little documents for you that you need to go download and get yourself. But they're not going to tell you because their attitude is they gave you a free document and it's not their job to tell you about it.
So what would someone with a simple or a SEP do if in that situation?
Yeah, you know, we'll pick on UBS. So if somebody has a simple or a SEP at UBS, they need to go to the UBS website and download the most current document and make sure that it's a 2022 document. They may not have them until the end of the year. Some places use the IRS model SEP. Those have not been released yet. And some brokerage houses have their own. But by the end of the year, you want to, you really want to, pay attention to that.
Well, this also kind of highlights the fact that with employer-sponsored plans, there are communication requirements that documents be provided on an annual basis. So can you sort of highlight, if you are going to sponsor a plan, what are some of those communication requirements or fiduciary responsibilities?
Well, so let's touch on the fiduciary part first. I mean, ERISA has been around since 1974, and I still haven't clearly defined who's a fiduciary. And I, for the life of me, can't figure out why this is so complicated. If I get paid money from your plan to give advice to your plan, I am a fiduciary. I think we're done with that. The states have scrambled all over themselves to make it clear that they are not fiduciaries in any form in these state-run plans. So they're mandating what you have to do, but they are completely exonerating themselves from all the fiduciary issues. And under ERISA, they're exempt because they are governmental agencies, and government agencies are exempt from ERISA. California just actually had a Supreme Court decision about a month and a half ago that upheld their position to not be a fiduciary and upheld their position to have Cal Sabers be a valid requirement in the state. Because they just don't want the liability that goes with this.
Mm-hmm.
So the fiduciary standards really still fall on the employer. You have a plan. There is no way for the employer to escape their fiduciary responsibilities. They can hire outside fiduciaries, whether they're 316 or 321 or 338. Those are all different forms of fiduciaries. You can hire an outside trust department to be to be a fiduciary for you, but ultimately the responsibility is still yours because you chose these people for those positions. So you want to vet your employer, your professionals well, and you want to find out what their credentials are to do these things. So that's the first part. From a notice perspective, again, it depends on the type of plan. So as soon as you're starting to say that you're entering into a contract with your employees when you have any kind of an employee benefit, what does the contract say? And the body of laws around that form of contract are going to define it. So in a 401k plan, I have to tell you what your rights are in that 401k plan. Are you going to get a match? Are you going to get a safe harbor? Are you going to get a profit sharing allocation? Because 401k plans don't stand by themselves. They attach to a profit sharing plan, which may or may not have contributions made to it. If you get money, what are your rights with that money? Do you get to direct that money yourself and where the investments are going to be? If so, what is the form of those investments? What are the fees attached to those investments? And that's another horror show of everybody scrambling to hide what their fees are. The companies that look the cheapest generally aren't. So those become the notices that the employees have to get. With the state plans, the employees have to get notices that we're taking money out of your pay. You have the right to change the amount of money we're taking out of your pay. You have the right to not have us take money out of your pay. All of those notices have to be in a form that's easily understandable by the participant. And then they have to have a way to go do it. And as I said, some states are requiring paper. Some states have an electronic component. If the employee does something on the electronic side, how does the employer know?
Right.
The major payroll companies seem to have this together pretty well. Aspire, which is a big record keeper, has 3 of the states. They seem to have a handle on it. But that doesn't mean it's going to get completely transmitted back to the employer, because the employers are all using different payroll. Some are doing it themselves. I still have employers that do it manually. You've got people using QuickBooks. You have, they're not all using major payroll providers. And quite frankly, as I've discovered, most of these major payroll providers do payroll okay, but everything else is sort of clunky.
Right. Well, and you have a lot of people that are paid either weekly or bi-weekly. So the amount of time that you have for someone to change their contribution and then capture it accurately in payroll, that's a narrow window.
It is, and a lot of these notice requirements, again, they weren't thought out, because the employer has got to react to what the employee may have done electronically. And I don't imagine that's going to be a major problem, but it's a bit of a headache for the employer.
But it's another data point that you have to track and stay on top of, and typically record keeping in and of itself is a burden.
It is. You look at New York City, how many little coffee shops are there? One of our clients historically, we had a guy who had a dozen hot dog stands. He's not sitting there in front of his computer during the day.
No, definitely not.
Sold a lot of hot dogs though.
So to kind of add on to this, there was also a bill on Capitol Hill, HR 2954. And apparently that stalled in Congress, but there's some thought that the House and Senate are going to revisit that this year. What do you think the likelihood of that is, or have you heard any more about that?
It's sitting there, it's in the background. I believe ultimately it's going to happen, because again, there's a lot of very positive components to come out of it. It clarifies the Secure Act 1 is going to actually clarify some of that. And again, we're back to having some sort of nationalization of a retirement program for people. It just, Washington moves circular. It's, so you're never quite sure, but I think it's going to happen. It's just not going to happen sooner than the states pull the trigger on their own stuff.
Right. Well, it adds another level of complexity. What do I have to comply with? And do I need to give both notices? And does the employee then have the choice between the federal plan or the state plan?
I think what's going to happen is once the federal plan comes out, people will have to just decide to pull the plug on whatever other thing they have, or keep it, because the federal plan is going to look pretty much the same as the state plans from a perspective of you have to have a plan.
So I feel like we've covered a lot in these 50 minutes, but also sort of just the tip of the iceberg. If there's any last questions, if you want to send them through the chat box, We will attempt to answer those in the next couple of minutes. We do have one question right now. So someone is asking on the state mandated auto deduction, how much are employees required to contribute from their paychecks?
Which state?
Well, I would imagine there's a range. What's New York?
New York is 3%, but New York City is 5%.
Okay, so it's gonna vary.
And most states are auto escalation. So they're going to increase at 1% of pay per year, depending on the state, anywhere between 6 and 10% is
Okay.
where the escalation will stop. And again, the
So-
employee has the right to go in and change that.
Right. So Ron, in the beginning of the presentation, you mentioned there's 14 states. I'm going to put you on the spot. Are you able to share with us all 14 states, just so everyone has a sense of where they might have some, they need to pay closer attention in the next few weeks or months? So we talked about New York State and New York City. We talked about California.
California, Colorado, Connecticut, Illinois, Maine, Maryland, Massachusetts, New Jersey, New Mexico, New York, Oregon, Vermont, Virginia, and Washington.
There's another question that we received. So are the states charging the employee anything to participate in a state-sponsored plan?
Absolutely.
And what is the range on that fee?
When you actually dig into the fees, they're all running. They're all saying they're capping them at 1%. But looking at a couple of the funds, they could be as high as 1.5%.
So it depends on the funds that the employee chooses to invest.
Yeah,
the money.
again, 3 of the states have gone out and hired a real fiduciary and said, listen, and that was Aspire that they hired and said,
Mhm.
let's go take a look at this. And Aspire is doing what they have to do, but there's still a cost to running these things.
Right.
And is all being taken out of the employee's share of the money. A couple of the states have their own investment people, and they've done such a stellar job with their own investments. So why wouldn't I trust them with my money? So, that's where they are with that.
Right. Well,
But generally speaking, it's around 1%.
yeah. I mean, the skeptic in me is always hesitant to give the state or federal government any more visibility into my personal financial status than I need to. So I'm just wondering, what about the day that I may be qualified for Medicare or Medicaid for that extent? Like, it just seems a little bit risky to give the state that much visibility into my personal financial situation.
And I can't remember which state it was, but one of them said that when the employer registers, you have to give them access basically to your corporate checking account. So they can just go and withdraw the money when they want to. And it's like, I don't want the state in my checking account.
No.
And I had to reread that section a few times. I mean, literally last night I was sitting down in the living room reading stuff out loud because you're reading it and you say, no, this can't be right. You say it out loud because your ears will catch stuff that your eyes don't. And it's like, son of a bitch, they really want to be in my checking account.
Right. Right.
So, to the things that they have to do, the employers have to, one, make sure they have a tax ID number. They have to register, and this is consistent with all the states. They're going to have to register at the state site. They're going to have to assign payroll designees and representatives and any HR personnel that has access to anything. They're going to have to identify their payroll service providers. I can only imagine changing payroll providers mid-year, what that's going to do to this. They've got to create a payroll list, the normal eligibility requirements. During the course of the year, they have to add and subtract employees as employees come and go. They have to notify the employees that they've been auto-enrolled. These are all auto-enrollment programs, which requires the employee to opt out at that point. And they have anywhere between 30 and 90 days to do that. They've got to submit the payroll contributions. They've got whatever account maintenance needs to get done, whether it's payroll deductions, you got to keep track of the newly eligible, opt-out requests, terminations, and changes in contribution rates. This all falls on the employer that may not know what the employee did. So this is, and some of the penalties themselves are not large. You know, I shouldn't say that, but you know, they're a maximum of $5,000 a year at most state levels. But the time involvement is really the cost here.
Right. Well, thank you so much, Ron, for spending time with us this morning. This has been tremendously helpful. As I shared in the beginning, we did record this webinar, so we'll be emailing out the recording and the slides to everyone that registered. Please feel free to reach out to Ron or myself after the presentation. We're sharing information here on how to contact Ron or someone in Ron's office to help you and assist with answering any type of retirement plan questions that you may have.
Do you want to go back to some of these questions that people had posted?
I've been kind of doing them as we go in the chat.
Yes, I saw that, you know, Anthony had asked a question about all of these plans are portable. So if the employee leaves, they can move them into another state plan, or I mean, they're individual IRAs. The employee owns the IRA. So the rules are going to be pretty much the same as any IRA that an employee would have. So they can, if they leave the employer and they want to move it to their own IRA, they'll be able to do that. That part's pretty clear. Now, what's not clear is there is a bill floating around at the DOL where they're concerned about leakage. And leakage in these retirement plans are employees that take loans that don't pay them back, or they take money as a distribution when they leave their employer and they spend it. And the concern is not allowing people to do that. Do I have to make this money stay there until retirement once it goes into the plan? And that's a legitimate concern. The other thing that we're seeing is a requirement for, and a couple of these state plans have a requirement that some of the money go into a form of an annuity, because people, the average participant has no idea what a lump of money equates to in terms of monthly income. You know, they think I've got $200,000, I'm rich. And this year we're going to see a requirement that we're going to have to start showing employees what that lump of money in their retirement plan equates to in terms of a monthly annuity. They don't have to buy an annuity, but they have to be aware of what it really is going to purchase for them. Because, you know, when they see a lump of money, whether it's $50,000 or $100,000, they don't realize it's only like $300 a month for life. Right. And it's just an awareness more than anything. I think it's positive, but it's scary at the same time.
A rule of thumb that has been shared with me is if you have $1 million in your retirement account, it'll throw off about $45,000 a year without you having to draw down. Do you think that holds true, Ron?
You know, I think it's a function of your lifestyle and where you're invested in all of those other things. Mm-hmm. You know, what distribution planning has changed. Again, this is more on the financial planning side, and it's not something that we do often, or we don't do it actually. But it's, you know, what's the withdrawal rate supposed to be? You know, and you know, people were saying 4% is your withdrawal rate, and some people are saying 5% is a withdrawal rate. And then some people get into these Monte Carlo stimulations to take money out. but the new mortality tables have us living longer. So the withdrawal rate is actually going to decrease, or people are going to work longer before they start taking money out of a retirement plan. Because if my life expectancy increases 8 or 10 years because of a change in medical delivery of medicine, then I need that money to last a longer period of time.
Very true.
You know, do I have long-term care insurance? That's going to have a big impact on my withdrawal rate. So there's a lot of variables, which is why having a qualified financial advisor is a very important component for people in this space. You know, we're the tax guy. We'll get you from here to there. Somebody else has to help you move into retirement.
Oh, absolutely. Absolutely. So I think there's one last question, and I'm not sure if you know an answer for this. Is there a single website or resource where there's aggregate information about all these state requirements?
I was not able to find it. You know, there are a number of the payroll providers have stuff because they have to report on it. So when you look at ADP or Paychecks, they have stuff there, but it's really partial cliff notes. And, you know, and unfortunately, it's more of a commercial for them to say why you shouldn't be there and you should be with us. So a lot of the subtleties are gone, but you can start to get an aggregation of what the different states are saying to the payroll providers. And those are the two largest ones out there.
Mhm.
So they have the biggest footprint. I know Paycor had some information on it. I did not look at Paylocity. I didn't look at Heartland. You know, these are major payroll providers. So, but there really is nothing out there from a, you know, each state's doing their own thing. They're not sharing this information with anybody else.
Right. Well, again, thank you so much. This has been tremendously helpful. Thank you for everyone for your attendance today. And hopefully we'll see you again on our March webinar.
All right, folks, have a good day.
You too.